I'm sitting here on a Sunday afternoon scrolling through the latest precious metals data, and three numbers just jumped off the screen. Gold down nearly 9% in the last 30 days. Silver crashed over 26%, and a major private credit fund managed by the world's largest asset manager lost 19% of its value in just one quarter. And I'm thinking these aren't random events. They're connected. And if you own gold, silver, or you're just trying to understand what's happening in the financial system right now, you need to see how these pieces fit together. So here's what I'm going to walk you through today, and I'll keep it structured because there's a lot to unpack. Three things. First, the actual confiscation risk to your gold and silver, because what people are worried about is not what's actually happening. I'll show you the three-tier framework that matters and how you protect yourself from the real threats, not the imaginary ones. Second, the brewing private credit crisis that the IMF is warning about, massive bank exposure, and how this could create a domino effect that reshapes metals pricing. And third, I'll give you a handful of mining stocks I've been researching and the criteria for evaluating them, not because I'm telling you to buy them, but because I want you to walk away with a framework you can use yourself. Let me start with the thing everyone's panicking about, and honestly, I think they're looking in the wrong direction. Confiscation. I see tons of videos obsessing over the same question. Will the government confiscate my gold like they did in 1933? And that's the wrong question. It's like asking if the government will send you tax bills. Yes, probably. But the methods will be completely different than they were 90 years ago. The conditions that made 1933 possible don't exist today. Let me explain why. Because Tier 3 and Tier 2 are what you should actually be watching. In 1933, Roosevelt ordered Americans to turn in their gold through an executive order. The U.S. was on a gold standard, so every dollar was theoretically backed by physical gold. The Fed couldn't print more money without more gold reserves. So what did they do? They confiscated private gold, centralized it, revalued it, and the government captured that 70% revaluation gain. Citizens lost, government won. But here's the part nobody mentions when making these fear-based videos. Compliance was abysmal. Only about 20% of private gold was actually turned in. Most people ignored the order and hid their gold. The government made a few examples, but they didn't raid homes en masse because, well, you start a civil war if you do that. So why won't this repeat? Three reasons. In 1977, Congress passed the International Emergency Economic Powers Act, which removed the president's authority to seize gold except during a declared war, not an emergency, an actual war. You could argue the U.S. is in a perpetual state of conflict somewhere. So, in theory, the authority still exists, but it's far more constrained. Second, think about the logistics. In 1933, most gold was in banks. It was centralized and easy to access. Today, somewhere between 33 and 50 million Americans own gold and silver. And it's stored where? Home safes, private vaults, buried in backyards, held overseas. There's no central registry, door-to-door confiscation in a country with 400 million guns. That's not a political strategy. That's a logistical nightmare. And third, this is the big one that takes the wind out of the sails completely. The U.S. is on a fiat system. The Fed doesn't need your gold to print money. They can create trillions with the stroke of a pen. Private gold in the U.S. is worth maybe $200 billion. National debt, $37 trillion. Why would you upset millions of gun-wielding gold holders for what amounts to a rounding error? The motivation that made 1933 happen doesn't exist anymore. So, forget the scary headline. That's Tier 1, and it's mostly noise. Tier 2 is where it gets more serious. This is stealth confiscation, and it's the modern approach. It's not about seizing the asset, it's about taxing it to the point where the effect is nearly the same. Picture this. Gold hits $10,000 per ounce, silver hits $250, and you're sitting on massive gains. You go to sell and the government says, "Congratulations, but we've implemented an emergency windfall profit tax on precious metals sold above current valuations. You made money, but they're taking 70% of it." And here's the thing. Do you think the outrage will be massive? Most people don't own gold. Most people will think, well, they got lucky, they didn't work for it, they just won the lottery. So this becomes politically feasible. Windfall profit taxes have precedent. We saw it with oil in the 1980s, the Crude Oil Windfall Profit Tax Act. Oil prices spiked. The government said those profits are excessive and they taxed the difference between market price and some government-defined baseline. Different context, corporate level, but the mechanism exists. We saw it in the UK with North Sea oil. And the reality is there's already a 28% capital gains tax on gold and silver in the United States. So the framework is there to expand it. And by the way, taxes on stocks are lower. Why? Because apparently holding something that's been a store of value for 5,000 years makes you irresponsible. But gambling on equities is encouraged. The real reason is Wall Street has a stronger lobby than the gold lobby. That's just the reality. But here's where it gets even more interesting. State-level confiscation. Everyone's watching the federal government, but California is floating a wealth tax. Illinois, New York, New Jersey are all watching. Why? Because these states are broke. Massive deficits, pension obligations they can't meet, infrastructure projects that don't pencil. If you own gold and silver in California and they pass a wealth tax that includes physical assets, what do? You move, right? Well, they thought of that. Exit taxes. You leave the state. They tax you on unrealized gains. Think about that for a second. Normally, if you bought gold at $1,000 and it's now worth $5,000, you have a $4,000 gain, but you haven't sold. You haven't realized that gain. An unrealized gains tax means they tax you anyway. So now you might have to sell some just to pay the tax. It's a mechanism that punishes wealth accumulation and forces liquidation. Anyone with significant assets will leave, but the exit tax means the state collects something on the way out. This is not seizure. They're not knocking on your door demanding gold. They're just taxing you when you make good decisions, and taxing the rich is always popular until the rich leave and there's no revenue left. Now let's talk about Tier 3. This is the end game, and it doesn't look like confiscation at all. In fact, you'll still own your gold, but you won't be able to do much with it. Central bank digital currencies are coming. CBDCs, the Fed, the Europeans, the Bank of England, they're all developing them. The pitch is simple. Digital money means faster payments, lower fees, financial inclusion. Sounds wonderful, right? But here's what they don't emphasize. CBDCs are programmable money. The central bank can see every transaction you make. They can control where you spend it. They can set expiration dates. Spend this $1,000 by next month or it vanishes. They can apply negative interest rates. They can decide what you're allowed to buy and what you're allowed to sell. It's no longer really your money. The government will tell you CBDCs improve monetary policy and financial stability, which basically means they can force you to spend, track everything you do, and shut off your access if they don't like your behavior, all in the name of stability. So how does this affect gold? In a CBDC world, try converting your gold into currency. You own physical metal. You want to turn it into dollars. Well, there are no more physical dollars. There's only digital dollars, CBDCs. You walk into a gold broker and say, I want to sell my gold. They say, sure, I'll deposit the payment into your CBDC wallet. But the central bank has flagged precious metals transactions for review. Your gold is stuck. You own it. It's in your safe. But you can't convert it without jumping through endless compliance hoops. Or maybe there's an instant capital gains tax applied the second you sell. Or maybe it's just a compliance nightmare. KYC review, 3 forms of ID, proof of source, suspicious activity reports, endless questions about where you got the money. You still own the gold, but they've muted its utility. That's Tier 3. And it's subtler and more effective than kicking down doors. Now, the biggest mistake I see retail investors make, and I've looked at thousands of portfolios, is not knowing when to exit. Why didn't you sell when you were 80% up or 100% up, and now you're 30% down or 70% down? This happens in every bubble, every bull market. Explosive growth, then collapse, and people don't know when to get out. Let me shift gears and talk about the private credit crisis, because this is the thing the IMF is warning about that almost nobody's paying attention to. And the most dangerous crises are the ones no one's watching. In 2007, if you talked to people about subprime mortgages, they'd look at you like you needed a hobby. Today, that's private credit. So what is it? Loans made by non-banks, hedge funds, private equity firms, asset managers. This is now roughly a $1 trillion market, and it's opaque. No transparency, no public reporting, no banking oversight. Nobody knows what these loans are, who owns them, who they were lent to. But here's the problem. These loans, yes, they're done by private institutions, but where do they get the money they lent out? Banks. Think about it this way. You have a private company that wants money. You have a hedge fund that wants to make money lending to them. Where does the hedge fund get the capital? Banks. The banks face heavy regulation on direct lending. But if they lend to a hedge fund that then lends to a risky borrower, the bank's exposure is technically to the hedge fund, not the risky borrower. See the structure? It's a shell game, and it reminds me of 2008. And maybe you think this is hypothetical. It's not. Trialor Holdings, a subprime auto lender, went bankrupt. First Brands Group, a car parts supplier, is struggling with debt. Subprime auto borrower delinquencies are at record levels. These are early tremors. We haven't seen the earthquake yet, but the ground is shaking. The private credit industry will tell you their models are sophisticated, thorough, diversified, you shouldn't worry. That's exactly what they said in 2007. Now let's talk about the elephant in the room, BlackRock CK. They're the largest asset manager on earth. They manage trillions across every sector. And they have a fund called the TCP Capital Fund. It's one of their private credit vehicles, and it suffered a loss of 19% of its assets in the last quarter. When the most sophisticated asset manager on the planet is losing nearly a fifth of a fund's value in 3 months, that's a warning sign. But it gets more dangerous. Private credit is tied to the banking system through derivatives, credit default swaps. If you watch the movie about the 2008 crash, you might remember they used a Jenga tower to explain it. In 2008, AIG needed a $180 billion bailout because of derivatives exposure they didn't fully understand. Banks are deeply connected to private credit indirectly, which means if it blows up, the entire banking system might need another bailout. And when banks fail, who pays? Remember Cyprus? In Cyprus, the banks failed and the government didn't bail them out. They did a bail-in. A bail-in is where the government takes money from depositors. In Cyprus, they took from everyone with more than $100,000. They seized 47.5% as a kind of wealth tax, not just investment accounts. Savings accounts, money you thought was safe. Maybe you think that won't happen in the US because they've always bailed us out generously. Well, there's a legal framework for bail-ins established after 2008. It's called the Orderly Liquidation Authority. Under certain conditions, the FDIC can convert your deposits to equity in a failing bank. Your savings become stock in a bankrupt bank. I'm sure it'll never be used, right? Just like inflation was transitory, this story is going to continue. I'll keep you updated. And in every crisis, there are opportunities. When it happens, if it happens, I'll tell you about those opportunities. Now, I want to walk you through some opportunities in the mining space because I think I've shaken you enough. Let's look for ways to potentially make money. Now, you might think, why not just buy physical gold and silver? Let me give you the simple version. Mining stocks give you leverage to metal prices. When gold prices go up by 10%, a well-run gold miner might see its stock price go up 30 to 50%. Why? Because their costs are relatively fixed. Digging gold out of the ground doesn't become more expensive just because gold is more valuable, so an increase in gold prices flows almost directly to profits. The flip side is when gold drops, miners drop harder. It's a double-edged sword, which is why risk management is critical. Let me give you a number example. Say a miner's cost to extract an ounce of gold is $200. If the gold price is $2,000, they make $800 in profit per ounce. If gold goes to $2,500, they now make $1,300 in profit. That's a 62% increase in profit from a 25% increase in gold. That's the leverage. And it works in reverse too, which is why you need to be selective. Let me give you the framework I use to evaluate gold miners. First, all-in sustaining costs, AISC. This is how much it costs, including everything, to get 1 ounce of gold out of the ground. Lower is better. Needs to be significantly lower than the price of gold. Otherwise, they're not making money. Second, production growth. Is the company growing production or declining? A miner with expanding output will see massive gains if metal prices rise. A miner with depleting reserves is a melting ice cube. Stay away. Third, jurisdiction. A lot of mines are in unpredictable countries. If your mine is in the Congo versus Canada, where would you rather it be? Think about tax laws, permits, nationalization risk, location matters. Generally, more developed countries mean lower risk unless they're run by someone with questionable policies. Fourth, balance sheet. You want relatively low debt and lots of cash. Can they survive a dip in metal prices? They need reserves to weather volatility. Fifth, and this is probably most important, stage of development. Is it a producing mine that generates cash every day, or a development project that needs financing and might find gold eventually? Producers are lower risk. Developers have potential, but can also go to zero. Let me run you through some stocks with this framework. And I'm not telling you to buy these. I'm showing you how I think about them. Starting with established producers, these are already mining, generating cash, lower risk within the mining space. Though there's still plenty of risk, so you always need position sizing and exit plans. First one is AGI, Alamos Gold, Canadian gold producer, 3 operating mines, 2 in Ontario, 1 in Mexico. Alamos released guidance saying they'll produce 46% more by 2028. That's guidance, not guaranteed. They're spending significant capital to reach 1 million ounces per year. They have free cash flow. Their all-in sustaining costs are around $200 to $300. They're spending heavily, which means less immediate returns, but if that spending pays off, they could make a lot more down the road. Second is Fortuna Mining, ticker FSM. They're actually called Fortuna Silver Mining, but 90% of their revenue comes from gold. They have 3 main mines, one in Côte d'Ivoire on the West African coast, one in Argentina, one in Peru. Geographically diversified, so no single country risk, but they're not in Canada either. So there's more jurisdictional uncertainty. If you look at the stock chart, you see what I call a heartbeat pattern, a breakout attempt, pullback, consolidation. For me, there are 2 possible entry points. One, when we break above resistance cleanly. Second, lower risk, when we break above the highest close in the range. I'm not telling you to buy it. That's just how I look at it. I wait for institutional money to confirm direction before entering. Third is GAO, Galiano Gold. Much smaller market cap, around 670 million. Small cap means price can move a lot more, higher risk, higher potential returns. They have a mine in Ghana. It's a turnaround story. They're spending 17 million on exploration targeting underground resources. They've reported 3.4 G of gold per ton, which sounds tiny, but that's actually pretty good. We're expecting a new resource estimate this month, so that's worth watching. The risk is it's a single asset. All production comes from one mine. If anything goes wrong in Ghana, there's no backup. Though Ghana is one of the more stable countries in Africa, that's still more risk than Canada or Australia. Now let's talk development stories. Companies that aren't producing yet but could become mines. Very high risk, very high potential. How do I handle that? I put a very small amount of money into them. I'm not telling you to put anything in. I'm not a registered financial advisor. I'm just showing you how I think. First is NFGC Newfound Gold, one of the highest grade gold discoveries we've seen in recent years, located in Newfoundland, Canada. They're seeing 500 gram per ton. Most gold mines bring a couple grams per ton. This is off the charts, which is why people are excited. They're expecting first gold in 2027, 18 months away. They have a permit for the milling facility. It's in Canada, very mining friendly. The risk pre-revenue, they're going to need capital, which means dilution. Second is VGZ, Vista Gold, pure leverage play on gold prices, single asset development company focused on a project in Australia. They have a mine called Mount Todd, one of the largest undeveloped gold deposits in Australia. At a gold price of $2,500, the company should be worth around $1.1 billion. Gold is worth more than that now, so you can do the math, but they have zero revenue, and the timeline for production is 2029, 2030. Third is NEWP, New Pacific Metals. This is the silver play. They're advancing two of the world's largest undeveloped silver projects in Bolivia. If you're bullish on silver, these are massive potential sources. They've managed to remove illegal miners from their sites, secured core protection. The new Bolivian government seems supportive of foreign investment. The stock is up quite a lot recently. It's been in a long consolidation and is starting to show signs of breaking out. The volume flowing in is impressive compared to when it was dead money. But Bolivia is not exactly stable. They have a history of nationalization. Community relations are complex, and silver is more volatile than gold. High risk, but the potential is there. So there you have it, your risk framework. Lower risk options like AGI and FSM. Medium risk like GAU. Higher risk development stage plays like NFGC, VGZ, and NUP. This is not financial advice. Mining stocks are not the same as owning gold. They're much higher risk. Make sure you do your own research and come to your own conclusions. If you just want protection, physical ownership is the best place to be. I would not get scared out of gold and silver because of confiscation rumors. They might tax it, but I don't think they're going to steal it outright. If you're invested in miners, diversify across jurisdictions. Don't put everything in one country. And if you hold substantial amounts of gold and silver, consider storage in different jurisdictions too, preferably private storage. Try to be as close as possible to your metal. Some people buy through a broker who uses a storage facility owned by someone else. So you have a contract with a broker who has a contract with a storage facility. How close are you to that gold? Can you go see it? Think about those things and stay informed with what's happening. This space is going to keep changing, especially if gold and silver prices continue rallying. The government is desperate for revenue. By understanding what might happen, you're already better positioned than 99% of people. That's always the goal. This is educational content based on publicly available information and market analysis. It's not personal financial advice. I don't know your situation, your risk tolerance, or your goals. Do your own research. Talk to a qualified professional if you need one.